The word mortgage literally means death pledge. Mort, death. Gage, pledge. From the Old French, 14th century. But here's the thing. It's not about you dying. It's about the deal dying. See, the pledge is dead in one of two ways. Either you pay off the loan and the deal dies, done, you're free, or you fail to pay and the property becomes dead to you. Seized, gone, forever. The banks didn't invent mortgages, but they've spent the last 100 years perfecting the art of keeping you locked in to that death pledge for as long as possible. Today I'm going to show you exactly how and why they think you're too stupid to notice. Canada has 6 major banks: TD, RBC, Scotiabank, BMO, CIBC, and National Bank. Together, they control over 85% of the entire banking industry in this country. That's not competition. That's an oligopoly with a marketing budget. Now, 4 of these banks, TD, Scotiabank, BMO, and National Bank, they'll work with mortgage brokers. They'll let their products compete in the open market. But the other 2, RBC and CIBC, made it a very deliberate choice. No brokers, period. RBC, the largest bank in Canada, literally said that working with brokers causes them to lose control of the customer. I'm going to say that again, lose control of the customer. That's RBC executive Dave McKay, not me being dramatic. That's the bank saying out loud that they don't want you to have options. And speaking of the banks killing competition, let me tell you about FirstLine. FirstLine started as FirstLine Trust, a trust company wholly owned by Manulife. It was legitimate, independent, and a mortgage lender serving the broker channel. Then, in 1995, CIBC bought it. For 17 years, CIBC ran FirstLine as their broker channel brand, and it worked. At its peak, the #1 mortgage lender in the entire broker market. 1 in 3 broker mortgages in Canada went through FirstLine. Billions of dollars. Exposed to the most competitive lenders in the country. And then CIBC got uncomfortable. See, when you're the biggest broker lender, your customers can compare you. They can see when someone else has a better rate. They can have options. So what did CIBC do? They deliberately starved FirstLine, started giving better rates to their retail broker channel, and made FirstLine less competitive on purpose. FirstLine dropped from the #1 lender to 4 in the broker market in just 1 year. And then in 2012, CIBC killed it completely. They tried to sell it first, but here's the catch. They wanted to keep all the existing mortgages and customers. They wanted to sell just the brand and the sales team. Shockingly, no one bought this deal. So they just shut it down. Their official statement, they wanted to focus on channels where they have greater opportunity to meet more of our clients' needs. Translation, we make more money when you can't compare us to anyone else. CIBC's CEO at the time literally said the broker channel resulted in single product relationships, thin margins, and lower levels of client satisfaction given the transactional nature. So their solution to low client satisfaction was to give clients fewer options. They bought a successful independent lender, ran it for 17 years, then killed it when the competition became inconvenient. Galaxy brain moment right there. Now let's talk about who's actually giving you mortgage advice at the banks. Imagine this. You walk into a restaurant, one person greets you at the door, takes your order, runs to the back, cooks your breakfast, brings it out, clears the table, does the dishes. How good is that omelet really going to be? It's your bank. The person helping you with your mortgage. They opened a checking account this morning. They processed a wire transfer. They helped someone dispute a credit card charge, sold 3 RRSPs, updated someone's address, and now they're explaining the biggest financial decision of your life to you. They're generalists. They know a little about a lot, And your mortgage, your $500,000, $800,000, $1 million mortgage, is just another item on their to-do list. Meanwhile, mortgage brokers do one thing: mortgages, every day, all day. And here's the part that'll really cook your noodle. Mortgage brokers in Canada are provincially licensed. We take exams. We have continuing education requirements. We're regulated by financial services authorities. Bank employees selling you a mortgage? No mortgage license required. But Andy, at least I have choices between different banks, right? Let me show you something. Every major bank offers basically the same products: 5-year fixed, variable, maybe a 3-year if they're feeling spicy. The rates are within basis points of each other. The terms are really copy-paste. And you know why? Because they're all funding these mortgages the same way. Their investment desks pool these mortgages together, package them up, sell them to investors. Same machine, different logo. The competition is really theater. It's like choosing between Pepsi and Pepsi in a blue can. But monoline lenders, credit unions, alternative lenders, actually different products, different underwriting philosophies, different risk appetites, different prepayment privileges, different penalty structures. But your bank doesn't want to know those exist, because if you knew, you might leave. Okay, let's connect the dots. Remember that death pledge? Here's how Canadian banks keep you locked in. We'll start with a bit of a weak one, but it's collateral charges. Most banks register your mortgage as a collateral charge instead of a standard charge. It sounds boring, but it's not. Here's what it means. When your term ends and you want to switch lenders, supposedly your free moment to shop around, no penalties, well, surprise. You need to pay a lawyer to discharge it. It's not a penalty, it's a fee, and they're going to say it's totally different. Trap 2, and this is a really big one, the nightmare prepayment penalties. Some banks use something called the interest rate differential, IRD, to calculate your penalty if you break your mortgage early. You don't need to understand the math just now, but just know this: I've seen penalties of $15,000, $20,000, $30,000 for the same situation. Some monolines just charge 3 months of interest, and that's it. It's maybe $3,000. Same mortgage, same situation, $22,000 difference. But did anyone explain that to you when you signed? Probably not. Trap 3, it's the renewal letter. 4 to 6 months before your mortgage term ends, your bank sends you a nice little letter. Dear valued customer, for your convenience, simply sign below and renew at this rate. Convenience for whom? Here's a stat that should make you angry. 70% of Canadians just sign that letter without shopping around. 7 out of 10 people hand their bank free money without even checking what else is out there. The banks know this. They're counting on this. That letter isn't convenience, it's a bet. A bet that you're too busy, too tired, or too trusting to look around. It's a death pledge indeed. Okay, enough doom. Let's fix this. Here's what you actually do. One is really just talk to a mortgage broker at least once. Even if you end up staying with your bank, you'll know what you're giving up. We have access to 30+ lenders, one application. You see the whole spread: banks, credit unions, monolines, all competing for your business. Remember, TD, Scotiabank, BMO, and National Bank all work with brokers, so you can still compare them through us against everyone else. RBC and CIBC are the ones hiding in the corner, hoping you don't look around. 2, really don't sign that renewal letter without shopping. At renewal, you are a free agent. No penalty, no restrictions. The new lender does most of the paperwork. All you have to do is not be lazy. Start shopping 120 days before your maturity date. Get at least 3 quotes. Make them compete. 3, read the fine print before you sign. Ask about the penalties. Ask if it's a collateral charge or standard charge. Ask about prepayment privileges. If the person explaining your mortgage can't answer these questions confidently, well, that's your answer. And 4, remember the bank is really not your friend. They're a business, a very profitable business. And that profit comes from one place, your pocket. Look, I've been doing this for over 11 years, over 1,000 mortgages, and I've seen the same story play out hundreds of times. Smart people, great credit, solid income, totally qualified, leaving thousands of dollars on the table because their bank counted on them not asking these questions. RBC doesn't want you to see this video. CIBC definitely doesn't. And honestly, it's exactly why I made it. Your mortgage is called a death pledge for a reason. Don't let the banks make it feel like one. If you want to see what the real best rates are, not just what your bank wants you to see, that's exactly what we did here at Everyrate. We shop 30 plus lenders and show you the results. No BS, links in the description. Subscribe if you want to get more videos like this. I drop new content every week, pulling back the curtain on the stuff that your bank hopes you'll never learn. Thanks again. We'll see you at the next one.